Welcome to the StackSource Industrial webinar. I guess you can call it a webinar, even though we're live on social media platforms. So we're live on Facebook, we're live on YouTube. If you're just joining in, we are just starting. We're going to wait about 1 minute for viewers to join. So we're going to start the discussion in 1 minute. So just sit tight. If you're just joining, your audio is working fine. We're going to start the discussion in less than a minute here. So just sit tight for about 30 more seconds. Okay. And here we go. Once again, welcome to the StackSource Industrial Outlook webinar. I'm here with a couple of industrial real estate experts. I'm here with a principal of a successful leasing, acquisitions, and investment sales brokerage firm. I'm here with the CMO of a very exciting startup in the short-term industrial leasing space. They're each going to introduce themselves in a second. We're going to have a couple of data points. We're going to have a few questions, and then we're going to turn it over for audience questions. This whole thing is going to be short, sweet, informative, but you'll have access to any of these experts, myself, our teams after the fact, and you'll have our contact info if you'd like to go deeper on any topics. But for the next 20, 25 minutes, we're going to be going through what is happening, what does the data say, and what's going to happen next in the industrial real estate space. So with that, I'm just going to mention that I'm Tim. I'm the co-founder and CEO of StackSource. We are the host of this podcast. We are also a commercial real estate financing platform. So we're bringing transparency to commercial financing. We are built for a time like this when the capital markets are in flux, truly because we track the lending parameters of hundreds of capital sources across the country and help commercial real estate investors get the right financing on their deals. And we do it in a streamlined and transparent way. Our website is stacksource.com, but I'm very excited to introduce our industrial real estate experts. We're going to bring up bios for them on the screen. They're going to introduce themselves to for 30 seconds each, and then we're going to get going.
Hi, good afternoon, everyone. John Karnick with Assurance Realty Group, co-founder of the company about 16 years ago. Full service corporate real estate, industrial and office specialist. We work on everything from leasing to investment sales of both industrial and office. And myself, my co-founding partner, and the rest of our team all come from big international backgrounds at the large firms like Cushman, Newmark Knight Frank, JLL. And about 15, 16 years ago, all just decided that we all have an entrepreneurial background, and we wanted to take a different approach to helping better serve clients in all segments of real estate. So, with that being said, we have a national reach, but we're a boutique platform. So you're getting a level of service that's pretty much unparalleled. You're dealing with 20 plus year veterans, and you're getting, not getting your deals shipped down to some junior level players. So, 24/7, when you get somebody on the phone, you're getting somebody that's a high level senior broker. So with that said, I'm going to turn it back over to Tim to introduce Greg.
Awesome. Thanks, John.
Hey, great. Yeah, my name is Greg Heaps. I'm the CMO and on the founding team of a company called Chunker. We've been at it for about 3 years now, so we're still a little new. And the idea behind Chunker is we've created an online platform or a marketplace providing a unique warehousing marketplace that connects organizations needing space on a short-term basis with those that have excess space. We're kind of like an Airbnb platform, but exclusive to industrial warehousing. So what that means is that landlords and tenants and 3PLs can now monetize unused space, excess space that they in the past have just sat on as a cost of doing business. While on the flip side of the platform, other businesses needing temporary space can search, locate, and license space fast. We've got all the tools in the platform to transact a deal, capture digital signatures, distribute funds, and we want to make it quick and simple for both parties. So that's the premise of it. We've seen an increase in deals and in both supply and demand over the last few weeks. And yeah, it's a great way to source space on a short-term basis.
Awesome. Thanks so much, guys, for giving your backgrounds. So we have a couple of people with very unique insights into the industrial space. They know where things are trading. They know how these deals are going on a short-term and a long-term basis. Now, each one of us three, me as a moderator, John and Greg as presenters here, we've picked out one stat or one set of stats that we want to call attention to. We're going to spend 60 seconds on 3 quick slides just to set the stage of where the industrial market is and what the data is saying. And then we're going to talk about that and have commentary and some questions about it. But John is going to go first. He's going to talk about specifically in the New York City tri-state, which is an extremely hot industrial market, what we're seeing and what the numbers are saying about vacancy and rent.
Sure. So as you can see from the slide, and let's start with, New Jersey and then wrap ourselves around, you'll see that it's an extremely tight market. And this is both for lease and for sales. So whether it's investment sales or whether it's owner occupant product that people are looking for, the deals are literally a needle in a haystack. And on the leasing side, you'll see that the vacancy rates are at a level that, we haven't seen ever in the tri-state area. The rental rates are and have been for the last 18 months creeping up. Now, just to clarify one piece on the New Jersey side, because people might look at this slide and say, why is the Class A space showing a lower average triple net rent? That's because the bulk of what's available in New Jersey on the vacancy rate side is in South Jersey, like below 8A. So we see a lower rate there. But in the northern part of New Jersey, 8A and heading north, you're really more like a $12 to $13 a square foot average rent on the Class A space. And then you wrap your way around to the outer boroughs and you'll see the rates. And what's been driving the demand in other parts of the tri-state area is the rental rate increases in New York City's outer boroughs. So, and it's done the same thing in Long Island. So what we've seen is a flux of people looking at upstate New York, people coming to New Jersey and Connecticut over the last 18 months looking for some rent relief. Because quite frankly, there's a lot of companies out there that are just getting priced out of the markets. So, we do work all over the country, but we figured for the purposes of this webinar, let's focus on the tri-state so you can get an understanding as to how tight the market really is and what the rates are doing. And, the rates have jumped significantly. And quite frankly, since the last 2 months, since we've been in this pandemic, there hasn't been much absorption, but there's a lot of people trying to posture and get ready for what's to come as soon as we come out of this.
Yeah.
So I think we're going to see the vacancy rates dip even more once we get to the point where people can really pull the trigger, once they have a better understanding of what their long-term needs are, which is where Greg's coming in play right now, because people are, jumping to him to figure out their short-term needs while they get settled in and figure out the long-term play and what's to come.
Absolutely. Great overview, John. And we'll dig in a little bit more to those trends that are driving this low vacancy rate and these high prices. But yeah, let's get to Greg for a minute. And Greg, we have a really simple stat from you. Can you tell us what is 50 to 100%?
Yeah. We get a variety of applications. Of course, the typical is going to be we get a call, midweek, and they've got trucks on the road and they need a place by Friday, and so we're scrambling. But we've accommodated video shoots. We've accommodated remodels for large, global brands. And so the opportunity here is that landlords and tenants can make as much as 50 to 100% premium over current market rates, mainly because short-term deals are hard to find. And so we expose that space for you. And, they usually come with an urgency. And so, we're seeing a nice premium and, an opportunity to generate revenue on space that otherwise was just sitting empty.
Yeah. Awesome. So if you're an industrial landlord out there and you've got some short-term openings in your space, I think that 50 to 100 plus could be of extreme interest.
Let me just say too, Tim, just so that it's clear, this is not a real estate deal. It's not a lease. It's not a sublease. It's and the landlord and tenant, they maintain control of the space. It's a short-term deal. So, it doesn't come with the rights that a tenant or a lease agreement would have. So it's far simpler, to your point.
Awesome. Thanks. And I'll talk about cap rates for a minute. And this is purely year to date. And this is not a New York tri-state number. This is the asking cap rates for industrial properties posted online for sale from January to present. And while that actually might seem like an even higher cap rate, keep in mind, this is across the country from the most rural locations to the most urban dense, including vacant buildings and everything else. We are seeing cap rates in April, in the thick of the COVID epidemic, fall even further and below 7% on an average annual basis for industrial properties. And our interpretation of that is, you better believe that industrial landlords understand the power position that they're in right now with retail taking a fall. So it's a great time to be an industrial real estate owner. Vacancy rates are low, rents are rising, and a lot of people believe, and they may be right, that industrial is gaining where retail is losing, and that might have just accelerated even further based on what's happening in the market today. So those are some numbers as they sit in the industrial space. And I want to take a couple of minutes and talk about why that is, talk about what's happening next, and then we're going to turn it over for audience questions. So if you have a question, if you're on Facebook, if you're on YouTube, pop in with a question at any time. We can take it now and we can address it with our guests here in a few minutes. I'll also leave their contact info at the end so you can address more direct questions or help with your own scenario to either Greg or to John or to I. But for now, I've got a couple of questions. So for both of you, how has the development of COVID-19 and the pandemic and people staying home and forced business closures, how has that impacted industrial real estate? If you can talk about that for a minute.
Greg, why don't you start, since for your model it's more impactful.
Yeah, as I previously mentioned, we're seeing great increase from both supply and demand side of the platform over the last month and a half, since we kind of slipped into the stay home, stay safe routine. There's just a great influx in the global supply chain. We're seeing some product categories that are emptying their warehouses and now sitting, and things are slowing down. There's some space there that can be listed. And then we're seeing just the opposite in other product categories. Food and beverage is huge for this, where they're at capacity, their manufacturing has ramped up, their inventory is ramped up, and they've got nowhere to put product. So we're seeing a lot of scrambling right now for short-term space. There's a lot of international product coming in on containers and nowhere for it to go. So it's been incredible. I wasn't quite expecting what we've been seeing, but there's been a real rush through the last few weeks and month as a result of all this.
Are you able to track some of that to things like masks and medical supplies and people trying to spin up manufacturing for things that they haven't had to mass manufacture before this?
Not so much, but maybe there's a wave coming. mostly it's been food and beverage. It's been hard goods. It's been, a variety of things, but I haven't seen a lot of medical yet. I did have an inquiry, but we haven't done a deal.
Got it. Okay. John, what are you seeing in the market is changing, if anything?
So on the long-term plans here, and it's not just me and my firm, it's all of my colleagues and friends throughout the industry. What we saw was deals that were out for execution, where we literally were on the 1 yard line, and everybody just pulled out, and everybody's just sitting tight to wait to see where things end up. Everything from a very large, 100,000 square foot expansion for a client who was in the food industry, but providing meals to schools. So guess what happened to their business? As soon as we shut the schools down, you're an immediate halt. And what we're also seeing is a lot of tenants that were either about to expand or about to renew. People are just taking a step back, waiting to regroup and see where things fall come, early part of summer. And I think a lot of the companies and a lot of our clients are waiting to see how they are going to be benefited by the PPP plan and the SBA loans that are going to help, offset a lot of their losses. And the other thing a lot of our clients are telling us, and the feedback we're getting, is they're having a hard time staffing their facilities because they either have people out sick or people just extremely concerned and not wanting to be in a workplace environment at this moment in time, in a warehouse. So, that's also a challenge. So a lot of our clients are working with skeleton crews and things of that nature. So we really have seen almost zero absorption since the beginning of this. We know there's going to be pent-up demand. We know that e-commerce is going to be bustling. And as you touched on before, the retail market is going to suffer the most from the impact of this. And then the next progression is going to be, you're going to see a massive change in the way people use office space.
Yeah.
So I think you're going to see more companies that were having their warehousing separated from their office that are going to say, hey, maybe let's go into more flex type product or industrial product where we build out a little bit more traditional office in our warehouse, consolidate the entities and streamline things. So, for right now, we're almost on hold, So that's what we're seeing.
Wow. So with the increase in demand, with people being cautious about long-term planning and getting a long-term liability onto their books as far as a tenant is concerned, are you seeing anything in the market that is facilitating a faster shift towards automation, robotics, maybe? John, you mentioned that they're having a hard time staffing their warehouses. Are industrial tenants and landlords thinking more about how do we build the warehouse of the future? How do we build the light industrial of the future? If that shift, do you think that shift has been affected?
Great point, Tim. Because people have had some more time to really think about things long-term and do some long-term planning, yes, people are definitely looking at how they can automate things that they maybe have held off on because they didn't want to spend the money in the past and they kind of felt like things were moving along fine. But yeah, I think we're going to definitely see people taking a harder look at that and how they can implement that going forward. But I think the big pause right now, additionally, is that the industrial rates have only been climbing for the last 24 months, and they're getting to the point where you're literally pricing so many traditional warehouse users out of the market that I think a lot of tenants are taking a step back and saying, well, let's see what this is going to do to the dynamic of pricing. And let's see if we're going to stop seeing the increases in rates. Because when you look at people that are doing these long-term deals, if the average rent on Class A is, call it $13 a foot in the more higher end parts of, the sources in New Jersey, that's not a flat rate. There's annual increases or every 5 years. So when you look at the blended average over the term, people are going, they're getting up to almost office rates. I think that the landlords are going to stick firm on their pricing when we come out of this, I think they might be a little bit more flexible as far as giving some abatement or giving some additional tenant improvement allowance to a tenant to entice them, but they're going to want to keep these high face rents. They're going to want to keep these high face rents because they're going to be an influx of refinancing, as you're well aware. And, they're going to want to stabilize these assets and keep the face rate high. But I also think tenants are being a little cautious because they want to see how their business is going to come back when we get back into the full swing of things before they can make these types of commitments at these higher rates.
Sure. Question for you, Greg. With what John's talking about and what he was talking about with the data of just how low vacancy is around New York City, for instance, 0% in Manhattan, for Class A product, and Northern New Jersey is through the roof. And from your short-term perspective, how are you seeing demand close to urban cores versus out in the middle of the country for some logistics business that just needs the space and they've got trucks on the road? How has that changed at all? What is the general sense of that, and how in demand that is for short-term space, rural versus urban, and has that changed at all over the last couple of months?
Well, first of all, good question, because when you ask, typically, we get in a conversation with a landlord or an owner of warehouse space. The last few years have been very healthy, and so there's been very little excess space from their standpoint. But what they're not realizing is, once they think about it, that it's clear is that their tenants have plenty of excess space. That when they sign a long-term lease, they take more than they need so that they can grow into it, and it's just part of putting the deal together, and they end up with, often twice the space they need. And in order to meet their rent and payroll and other financial obligations, that additional short-term income can be a game changer for them. So from a landlord's point of view, they should be looking out for their tenant base and shoring up, the rent coming into the landlord by helping their tenant fill that excess space with short-term opportunities. As far as your question, rural versus, more metro, we see a variety of everything across the country, and it kind of ebbs and flows, and every market's just a little bit different, and some are very, have a lot of room to negotiate fees and timelines or timescapes, and others don't. They're very tight, and they don't, they're not as open to doing short term, and it just kind of depends on the market. Obviously, the bigger the market, the more space there is there, regardless of what landlords are saying. So it's all over the map, Tim.
Okay. John, you mentioned that tenants are reluctant to sign these long-term leases. When do you foresee that thawing out? Do you think it's as soon as people are going back to work, they're going to get right back onto the deals that they didn't quite sign a few months ago? What's your outlook for this year?
Listen, in the last 2 months alone, we've seen some product come back onto the market, right? Because people did not pull the trigger on the renewal or the expansion that they had teed up. And I realistically think that, until our country is reopened for commerce 100% again, which, depending on the models, who knows? Is it a month from now? Is it 3 months from now? But until things, especially in the tri-state area, really open up again, listen, there's other parts of this country that are, opening or open.
Yeah.
Different there. But around here and what we're dealing with, I realistically think that I don't think people are going to be back at the table and really hard pressing deals until the end of the summer, coming into spring. And I think even then, the big impact will be, are these kids going back to school? Are the universities open again? Are the public schools, grade schools open again? All of this stuff is going to affect our market and the absorption of this space. I think we're going to see more space coming on board because I think there's companies that are definitely not going to survive this. But, with that being said, there's going to be other companies that are going to swoop right in and grab this space. But I don't have a crystal ball. I don't think any of us do. But I realistically don't think we're going to start seeing any real type of absorption until we're back functioning, economically in the tri-state area. I mean, people are working, but nobody knows what's going on. And quite frankly, depending on what happens, if this thing becomes the new norm and we have to worry about a recurring, theme of this COVID-19 coming back in the fall and winter of next year, we don't know how this is going to impact things yet.
Sure. Yeah. Greg, any different thoughts than that?
No, I'd agree. I think it's a little bit of an unknown, and we'll just have to roll with it.
I mean, I really think that Greg and your platform is going to you're going to blow up. I mean, you're going to see deal velocity at a whole nother level because people are worried about where we're going in the future, and your platform and solution gives them the ability to operate and function, and sometimes it's worth paying the premium for the flexibility. Yep. Now, what will be interesting on my end is to see if landlords start to realize, hey, maybe we should be a little bit more flexible, and instead of shooting for that 10-year term, let's roll the dice, charge a little bit of a premium, and do that 1 year to 3 year deal, which is almost unheard of in the markets.
Yeah, take the revenue that's on the table. Yeah. Yeah, in fact, speaking of that, our term goes, we've done anywhere from 2 days to 2 years, and people have asked, 2 years, that's a short-term deal? Well, when signing a long-term lease is 5 year minimum, or maybe 3 years, 2 years ends up being a short-term deal.
Sure. Yeah, listen, in the tri-state, there's for every piece of space, there's 25 people that want it. Landlord's going with the best credit he can get, at the best rate he can get, and at the longest term he can get.
Right. And it also plays into the financing, because in the capital market side, the way a lender sizes up an industrial deal is they say, how likely is it that tenant is going to pay, and how long are they going to be here? And that's really about it. There's not too much more difference from one warehouse to another, location to another, because if you have a 10-year tenant that's in there, that gives a lender certain certainty that they can give you a certain amount of money, ask for rent payment or interest payments back, and you're going to get reimbursed by rent payments as the landlord. And that's what they can rely on. Traditionally, they've hated short term, but we're in this market now where there's so much demand for it that from the financing perspective and from the capital markets perspective, the shift towards short-term industrial space is a really interesting one. And Greg, I think what you brought up about it doesn't have to be the landlord renting out a large swath of their property to a short-term tenant. They can lease it to a long-term tenant. Tell that tenant, hey, take the full warehouse. I know you only need 70% of it right now, but we're going to help you rent out the other 30% on a short-term basis to these other players that need it. And this is a great place in high demand. Yeah. And what do they do in that case, Greg? They split some fees?
The landlord could, do a revenue share with the tenant. Absolutely.
Now, Greg, and this might be a question that somebody else will be looking to ask, so I will ask it for them. Is it more like a licensing agreement, since it's not technically a sublease document, or?
Yeah, it's exactly what it is. We've used a licensing agreement that's common in industrial real estate. Of course, we've aligned it with our business model, but it's common, it's familiar. We're trying to keep things familiar and not, make it too different or unknown. And that license agreement is built right into the process. So when they move from exploring and investigating space to licensing space, then that agreement kicks in, and they can redline it if they want to. Typically, that's used if some bigger brands, they've got some ways of doing business that are Part of their requirement, they could even swap out their own license agreement in our system if they wanted to.
Interesting. Great. So I will once again mention for those viewing at home, if you'd like to ask any questions of Greg or of John or of me, you can ask live right now, and we can go over a couple of audience questions now. I'm also going to leave up, as we close in a few minutes, I'm going to leave up contact info for all three companies and for all three of us. But if you have any questions, they can go in the comments on YouTube. They can go in the comments on Facebook. But we'll give it a minute here to see if any more questions come through. Otherwise, we're going to cap it off. I promise this was not going to be an hour-long, boring industrial webinar, and we're at about 30 minutes now. So we can cap it off. But if you have any questions and you're in the audience, go ahead and give us a comment on one of those two platforms. We'll give it a few seconds. John or Greg, do you guys have any other thoughts that you want to share before we close out?
John?
At this point, I think I see some questions popping in now, so let's take a look at what's coming in, and we'll go from there to wrap it up.
Cool. All right, so we've got a question for Greg specifically. Steven wants to know, what is the ideal size of the space range for Chunker? And he also wants to know, what is the absorption rate for listings on Chunker?
The size just is all over the place, depending on what the need and demand is. We have, I think it's 1,000 square foot minimum. I think we've even done 500 square feet. It doesn't happen very often. And we've done all the way up to 100,000 square feet and more. And the way our model works is it is truly an Airbnb style platform. This isn't a virtual 3PL where we have software that we require you to use, or where we add on services for moving product in and out. Although we can provide that if you want, and we do it through partners. This is a square footage play. If you've got some pallets to store, some dry goods, or even we have refrigerated and freezer storage as well. But you find your space and drop your product there. It's kind of like a hotel room. You don't sign a lease. You sign an agreement to use it for 3 days. When you're done, you take your stuff and you leave. And that's really what it's about and how it works. So we're seeing a variety of sizes that come through, and we're seeing about it's on the rise right now, and it's nearing 20%. Of our, those leases that are in listings that are in the system that are turning into deals. And I expect that will go up. We're still a young company. We're still growing our listing inventory. We have about 10 million square feet of short-term listings in the system now. We've got a couple of clients we're talking to that could double that real quick. So, and as things continue on the rise, I think we'll see that improve.
We've got another couple questions coming in from Mike, and he is asking, what is the best resource for finding comps in the Southeast, and what are the major opportunities, and who are the primary users in the Southeast region? So if either of you have brief thoughts, and maybe Mike can connect with you later as well for more specific guidance.
Yeah.
But do either of you have a quick insight to share about the market in the Southeast?
I can respond to the comps portion real quick, and that is you want to talk to a host of the local people that are. Listen, the easiest way is to talk to people that are in the marketplace, that are seeing what's going on in the past 12 months. The appraisers are a great resource. You can use CoStar /LoopNet as a mine. I mean, so much of their information is inaccurate that really going to the local appraisers is going to get you the best spotlight on what's going on in that marketplace, because they're looking at the lease comps to help figure out the valuation for the assets for guys like Tim to get them financed. So they're usually going to have the latest and greatest comps, both on sale and lease. So you take a handful of guys in that marketplace that are working that area, and that's going to be your most accurate resource.
So on the short-term front, Tim, there is no cost to list property on Chunker. You can list as much property as you want. There is no cost to go out and do a search and search for property. All you need to do on either side is create an account, which will just give you access into the system, allow you search on areas like this Southwest region you're talking about, and you'll be able to see all the properties in the region. You'll be able to scan out and scan in by, by mileage and a radius, and pick up, what properties are there and what they're going for. So no fee. The only fee is exchanged when someone finds space and they put a deal together. And as far as that goes, the no fee, it's just creating an account and you're off and running. It's pretty easy.
Got it. Again, we'll have the contact info for both Greg and John and for myself up at the end here as we close out. We've got another question that came in from Jason, and he's asking specifically for John, with the rising lease rates in the tri-state area, is that affecting smaller manufacturers and job shops? Are they going to be priced out of the market?
So it's an interesting question, valid question. The short-term answer right now is yes, we've seen a lot of these smaller manufacturers and job shops having difficulty finding space to occupy given the rate increases. So they had been in these units of space for so long, and all of a sudden the rental rates have jumped significantly. And yes, they are slightly getting priced out of the market. The flip side of that is, I think that given what we've just dealt with for the last several months, I think people in the United States are going to be willing to pay more for product manufactured here. And I think we're going to see a shift in manufacturing and jobs coming back to the States, which then should hopefully enable you to pay the slightly higher rates to stay here and local. With that also being said, we've had a lot of our long-term clients who started to get priced out that said, you know what, with the favorable financing out there, we're willing to pay a premium to acquire our own facility. And in many cases, they acquired something larger than what they needed. We leased the space out immediately, which helped, cover a nice portion of their financing, gives them built-in flexibility for growth in the future. And they've realized that, hey, given the favorable financing, assuming they've had enough of an equity position to put down as the down payment, that, acquiring their facility for the long-term needs made a lot of sense. So the last couple of years, we've done a lot of, representation of buyers that were on the smaller scale side of things that either bought exactly what they needed square footage wise or bumped it up a bit. So they either had future growth built in or at least a revenue stream to help support their acquisition.
So there are different options. So if you're a small manufacturer, you're in the tri-state area, leasing should be looked at. Buying and leasing out some of it should be an option. Good thing is that if there's a saving grace, rates are low if you're financing. So being an owner, it's a great time for that. We are coming up on 40 minutes. I'm going to cut this off, but again, we're going to put the contact info up here, and I'm going to close with that. If you want to reach out, you have John, you have Greg, you have myself. hello@stacksource.com. We'll get directed to the right capital advisor at StackSource. If you'd like to reach out directly to me, I'm Tim@stacksource.com. But hello will get you to our team, and one of our capital advisors based on your region will be able to respond. I want to thank John and Greg for dropping some insights for us here. Any other closing thoughts, gentlemen?
Thanks for having us, Tim.
Yeah, thanks, Tim. Appreciate the opportunity.
Thanks, everyone. And we'll be doing this again with another asset class soon. Have a great day.
Bye now.